Welcome back to our swing trading workshop, and we were talking about the definition of the market, um, and we were talking about changes of character and how to quantify them. How could we see from the numbers, where the confirmation of the reversal of the trend occurs. And one of the measures, that we've talked about, for this type of confirmation is the measure of volatility. So there is a question, does TradeStation or any software measure volatility? There are quite a few volatility tools that you could use. Uh, we had an October special with Corey Rosenblum, and we've talked about the volatility. One of the things that he does is uses the Bollinger Bands. A contraction of the Bollinger Bands would, show the volatility case. I'm using a very simplistic identification of the volatility because we just want to measure the reactions or the rallies in a more quantifiable way, and this would be, the way for us to go about this, if we want to have a very simplistic tool. Another question. It seems there is no UTED or sprint for secular trend reversal. It makes lower high at the top and higher low at the bottom. All right, so yeah, what about it? And I mean, in different instances, we're going to have different structures. So here in 2003, we're having in March of 2003 higher low, slightly higher low relative to the previous two lows. So there is no spring. In a way, it kind of gives us a clue that, maybe the next rally is going to outperform any of the previous two rallies in the trading range that we have. But if you go to the example of 2009, then the low in phase C, and we'll look at that, the low in phase C is going to be a lower low. So it just depends on the availability of the supply in this structure. So yeah, it's just, related to the specific instances. I don't think that there was a question there, though. All right, so let's come back to our observation. So we're looking at the sign of strength backing up action, volatility decrease on this more meaningful reaction than anything that we've seen before. So this acts as a confirmation of the reversal, and now we know at this instance right here, and it took us, yes, a little bit more time than we would prefer, but there were some other signs that we could use as well. Excuse me. We basically early on still into the long-term trend, because you have to think in terms of the long-term trend. What is the long-term trend? Well, we definitely were in the long-term down. Then we shortly consolidated. Please note that this consolidation, the duration of this consolidation is not significant relative to the previous consolidations that we've had on the move to the downside. But then the way how the price behaves in this area tells us that there is a change of character, and now from the long-term down, we are in the long-term up. So therefore, right away, definitions for intermediate trend is going to be changed. We're going to be in the up, at least right here, coming out. And then short-term, let's say if we're still here in this area, also going to be up. What does this present to us as an opportunity if we're swing traders, even if we're long-term swing traders or short-term swing traders? We're going to be extremely aggressive now, swing trading to the upside, because what kind of trades did we have on the way down? We only had swing trades that were to the downside, unless we are seeking some kind of stocks that are counter trend trading. the market, then we might have some positions to the upside. But those are going to be counter to the major trend in the down environment. So therefore, those are going to be extremely difficult to trade. Once we're in the up environment, then we're going to be extremely aggressive with our either long-term or short-term swing trades. And the opportunities for us are going to be all about any type of meaningful reactions or smaller counter trend reactions. So for instance, let's say that we are acting only after the confirmation of the change of behavior and the reversal of the downtrend. So on any of the lows that are giving us some kind of, more or less significant reaction, after each of the reactions on the reversal, this is where we would be seeking to open the position in the direction of the long-term uptrend, in the direction of the intermediate uptrend, and obviously in the direction of the reversed short-term trend. But for the short-term trades, we do need those type of reactions, because it's out of those reactions that we're going to have the synchronicity with the market. Remember, we were going through the idea of the synchronicity with the market, and that the best trades for us are always in line with the market. They are the easiest trades, they are most profitable trades, and they are so easy on the selection for us. So any type of swing trader would be looking for initial reaction, reversal, and this is where we would be going into our selection process. Now, because these reactions are happening so fast, one of the things that I'm advising my students and my private clients is, once you see the market starting going down, you really would like to start going through the selection right away. So what does it mean? That means, again, that once you've entered here or here or here or here, the rest of the way, you're not doing anything. You shouldn't be doing anything. You should be away from the market with all of the positions on and just enjoying the rally and enjoying the profits that your selection has made and actively managing those positions. But there is no selection process in this area right here. Why? Well, because it's a little bit too late. You should have done your work in this area right here. So therefore, and because those reactions are so small and they happen so quick, once you hit a specific number, let's say like -1, -2, -3% on the reaction, each day you would have to go through your watch list for the stocks that are already on your watch list, or start creating those and start identifying those opportunities. A question here. There is no structure for those short-term trades on a daily chart. Should we go to intraday for structure to make short-term swing trades? This is a really good question. So the question is, on this reaction on the daily, let's say this reaction right here, there is not necessarily, a Wyckoffian structure like we have here, like this whole trading range with a sign of strength in the backing up action. So you can answer this question, from two perspectives. Well, first of all, you are going to have some kind of smaller structure, and the idea of the going to the intraday is actually quite applicable here. You can, apply the same ideas here in this area, in this area, in this area. What I'm saying is that you have to do it a little bit earlier. You have to go into your selection algorithm a little bit earlier. And just because there's new slides, guys, and I'm going through this like first time, I'm definitely seeing how I can improve the slides for the next time, and how to improve the delivery of these ideas. But so there's going to be a lot of verbal definitions, today on this. But what's happening is, once you start going into some kind of reaction after the area of the confirmation, your first thing that you should start doing is the selection process on daily basis. And then secondly, as the price goes even lower, you kind of can anticipate what kind of reaction you are going to have in this instance. Well, think about why. Why would we anticipate a specific reaction at this spot? Right here, 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 maybe here. Because after the confirmation, we can look at the history of what kind of volatility we are going to have during the rally. So we're having 6, 5, 4, 6, 6, and those are even, large reactions right here. So going down and coming to -4, -3, -4.5%, 5% is quite acceptable. This is the current volatility that we are having on a normal reaction. So therefore, you can go to the intraday right here, and you could, work on your more defined entry there, on the reversal. But the second key here is going to be kind of like a follow normal reaction characteristics to unfold, and then anticipate that the volatility is going to remain the same if with an assumption that the trend is going to continue. So those are going to be our great opportunities to come in and to go through the selection, expect the same type of the volatility on the reactions, and then go to a smaller time frame and expect some kind of reversal, short-term reversal. And out of the short-term reversal, intraday, you can use that, or just a reversal on the daily reversal as well on the significant bars, right? So, and that's going to be the process for a swing trader for us after the confirmation and during those healthy reactions. And this is the time when we have to be extremely aggressive. Here, we are too late. We should be already in the position, and this is not appropriate time for the swing trades that we're looking for. Okay, a couple of questions. Can you make some comments how to create this watch list? Yes, we're gonna go through those. What time intraday provides best fit for structural analysis? Well, I think it depends on the structure. I mean, obviously, like in the areas like this, you would want to go, and because there are like 2 or 3, 4 days, you would want to go to at least like an hourly chart. So, and I think the hourly chart is going to be sufficient. I don't want to push you to a lower time frame. If anything, I want to push you more to the higher time frame. But on the points of entry, if you want to be more accurate and you want to be more precise is probably a better word here, then you definitely can go to the intraday. And I only would do this in case if you have time to follow the intraday charts, because if you're working 9 to 5 and you only have maybe like one opportunity per day to look at the market, maybe at the close, maybe in the evening, maybe in the morning, then you really don't have a lot of time to think about the intraday action. And my recommendation would be just to observe the daily reversal after the reaction, and that would be the day for you when you are most active with your position opening and with your selections. But the key is to start creating the watch lists during the reactions so that we wouldn't have to be extremely busy, at the bottoms here. When we see V bottom, is the bar analysis sufficient? For what? For the reversal? Yes, absolutely, because even with the V bottom, you would have some kind of reversal there. For identification of the trading ranges, again, with the V type of bottom like this here, you're still going to have some areas where the trading range is going to be there, so you can definitely go and figure this out. V bottom has a specific way of how it unfolds, so you have to understand that. You have to understand the oversold condition extremely well and how it's being reversed. So, and you can do this both in either of the time frames. Either it's an intraday time frame or a daily time frame. This is an interesting question. Will both swing type trades before confirmation, so before the sign of strength in the backing up action, be more risky and not appropriate for trading? So the question is all about this area right here. As we're having the backing up action and a sign of strength right here. What is appropriate here for swing traders? And I would say that anything is appropriate here in this area. We're just using the definition of the change for a much longer term trend, right? Where we could become more aggressive here in our swing trading and further down the road here, and then we still could swing trade even this swings right here, even within the structure. So this swing is still within the structure here. We could trade any of the swings that we have in the down market right here, because as swing traders we don't really care. We just want to have a good swing to the upside, so all of these swings are appropriate. Even the smaller ones, if you are very confident in your swing trading, you can find the selection where you will find the stocks that will outperform. And it naturally happens in the market because some of the stocks are going to be more attractive based on their valuation, potential valuation into the future for the institutions, and they're going to outperform on the swings. And it's totally appropriate to swing trade this moments right here, this rallies. So therefore, when we come to the last trading range that confirms the reversal, the swing to the sign of strength rally right here it is also going to be traded. Now, maybe in the future workshop, I'll have some material on how to trade those swing trades, during the down markets. But because it doesn't happen that often, there is no really need for us to even do that. And we could profit from the down market in so many multiple different ways. We could just open the inverse ETF position, or maybe options to the downside, and just be in line with the market. But the key for our today's discussion is just to define what where the market is, and then just become more aggressive with our swing trades. Now let's look at the continuation of this, and this is extremely important because then the next question usually that comes from students or clients is about their accumulation area. And usually the tendency here when volatility starts to increase is to think that this is it, we're done, and now we're going to go down. So, and it's a definite faulty thinking on our part. We have to be more specific as to the definition, what the trend is. So let's look how it all unfolds. First of all, let's note how volatility has been decreasing, going through all of those reactions. So all of those reactions are extremely healthy on the way up. We have the confirmation in this area for the long-term trend up. And then suddenly we're coming in and we're having the largest reaction to the downside. It actually should be a little bit more. I'm not extremely precise on this reaction, so you can see that I took this high and I went up to here. It should be up to here, so maybe like 6.5, 6.7. With an exception of this reaction right here, everything else is below that number. So in a way, quantifiably, it shows to us that this is a change of character, and that this move to the upside, at least for now, is done. And at the minimum, it doesn't mean that we're going to go down, but at the minimum, we're going to consolidate. And during this consolidation, we have to define what is it going to be. Is this going to be a distribution, or is it going to be a reaccumulation with the further resumption of the trend and continuation? How do we do that? Well, obviously, we're going to go through the structural analysis, and we're going to, talk about the number of tests, the second point of fear, phase C, change of character on the way out. But on the supply and demand side, what we would be interested in is a decrease in volatility if this is a reaccumulation, and then increase of volatility to the downside if this is a distribution, and decrease of volatility, to the upside if this is a distribution. And we're seeing here how volatility is actually slightly increasing, and then on the next reaction, decreasing. What's happening with the rallies? Smaller rally, bigger rally, larger rally. So we're seeing how going into this area right here, volatility to the upside increases and volatility to the downside decreases. So therefore that area right here is our confirmation of a potential reaccumulation. Now, a more interesting question with just definition of a trend based on the volatility is, what are the spots in the trading range after we have confirmed the long-term trend? What is the first spot here that we could start trading to the upside? And I would say that for us swing traders, that spot is actually going to be all about phase C. Why? Because the assumption here is that the new long-term trend is established and that the current consolidation is indeed going to be a reaccumulation. And therefore, the first favorable spot for us to trade it is going to be phase C in this downsloping range. So here's our first opportunity. Our second opportunity is going to be on the sign of strength bars. Our third opportunity is going to be all around the backing up action. And our fourth opportunity is going to be on the breakout of that backing up action. So instead of here, if we are not sure, in this area where we are, we might be thinking that maybe this is just still phase B, which will be an arrow, and we are not actively trading this range, and we are starting to actively trade after the confirmation. During a stepping stone, after the long-term trend has been established, all of these points are appropriate for us to start swing trading and being more aggressive right away. It's the idea of resumption of the trend, resumption of the leadership in the stocks that you've picked for your swing trading, and resumption of the momentum. And it happens the same way, right? So look at the sign of strength rally, 8%. Larger than any of the down moves, larger than any of the percentages on the up move right here. So we're definitely seeing that the rally has changed, and then the reaction is definitely changing as well relative to the volatility that we've had before. So a continuation. Okay, great. Then the next chart, and here I'm going to go a little bit faster because now that we went through the concepts, I think what's important for us is just to cover this and then to go to another material. And I would encourage you to, after the workshop, to have these slides in front of you and just go really like reaction by reaction, in the definition of all of these points. As the market goes up in 2005, we have another change of character. And we're kind of seeing that we had 4% declines, 3% declines, now almost 8% decline. So not a very drastic decline that would define, more of this kind of like a secular lows for sure. It's more of the cyclical low, and we could expect some kind of consolidation. We're seeing the next large reaction, kind of like the same type of volatility, the next large reaction, the same type of the volatility. And out of all of them, and I didn't put it here, but out of all of them, you are going to have the rallies and decrease of the volatility. That's basically going to tell you that we are going to go up at some point. So I'm kind of missing a couple of green boxes here. But in this particular case, in the last one, we're seeing how the rally is starting to outperform, and the volatility on reactions is just regular reactions. And those are the type of reactions where we would want to establish our swing positions where we would want to go through the selection process and identify the trades that are going to be available to us, the leadership that's going to be available to us on this move to the upside. And we're still thinking that the long-term trend is up. There is really nothing in all of these reactions, like 6.5, 8, 6.5, 8, and previous to that we had 7.5, maybe 8% as the largest reaction. We've never seen anything like we've seen at the beginning of the bear market, where the reaction is, look at these reactions, minus 15, 8, 7, 15, 10, 10, 21, 28, 34. So this is not the type of volatility that we're seeing on the way up, even on the reactions that seems to be like the largest reactions in the uptrend. And only with this reaction right here, finally we get into the number where we're seeing that volatility has increased drastically. It's larger than anything that we've seen on the way up. So this constitutes a change of character, and a change of character for the whole move since 2003 that we've seen. And that would be an early indication of a possible either distribution or a possible much longer term reaccumulation. So let's look at that. And here we go again. And it kind of resembles the same picture that we've had in 2000 and 2002, right? So first change of character, increase of the volatility, largest move down in all of the reactions in the cyclical move up. Then we are having a consolidation. Through this consolidation, we're still having a quite high volatility on the way down. So that confirms that the increase of volatility suggests a distribution rather than a reaccumulation. Once we go into the consolidation, we are going to have some kind of continuation of that newly established trend with the bearish change of character, and we're seeing that on the way down, volatility increases even more. So here you should be so confident that we're already in the potential distribution right here. We definitely want to see the confirmation of the trend with the lower lows, lower highs, which we observe here in all of these instances. And we're seeing that still volatility is really high. I mean, all of these numbers to the downside, they're just like huge numbers. They are not the numbers where we are reacting, 5%, 7, 8%. These are big, big numbers. So environment has changed, and therefore our tactics for our swing trading is also going to change. So from upswing trading, we are going into the downswing trading mode, and we are selecting the candidates that are outperforming the market to the downside rather than to the upside. Let's look at 2009 range, and here again, look at the volatility, 35 on the way down. During the range itself, quite a high volatility on the way down, 22, 26, 15, 24 going into phase C. And then the next rally and the next reaction, this is where the confirmation comes that we are done with the long-term trend to the downside. Look at this rally, 43%, larger than any of the numbers to the downside. We're definitely having the rally that is much more than any of the rallies that we've experienced in the trading range, so a change of character by itself. And then more importantly, on the backing up action, look at the volatility numbers right here. We're not even exceeding the 10%. So it's very reminiscent of what has happened in 2003. It's very reminiscent of what has happened in any of the reaccumulation ranges that we've seen. And this acts as a confirmation. So how would we trade this? Well, obviously, as I mentioned before, we would be swing trading this. We would be swing trading this, but we would not be very aggressive. It's only as the character of this rally changes, we might become a little bit more aggressive, let's say in this area right here. just judging by the first momentum move, let's say out of this condition, and how the price actually reacts, we could observe that these reactions are somewhat different than the reactions in the trading range that we've had right here, let's say on this rally. There is more supply in this area than in this area, so that suggests the continuation, and therefore we could establish, some swing positions to the upside in this area. How would we do this? Again, we would be looking for reactions, right? So reaction to the downside, minus 5%, you go to your selection, and then you go to your, you create the watch list, and we'll talk about how we're going to do this in a second, and then you're going through your trade management, for the trades that you've established. Once we've experienced a sign of strength in the backing up action and we're confirmed to the upside, then we could become more aggressive. And we are going to swing trade to the upside in a more aggressive manner. Let's go through this a little bit faster. Okay, so this is our backup. So any type of reactions on the way up now, here, 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 that are going to be in line with the reactions of the first rally, that are going to be in line with the volatility that we've had on this move to the upside, are going to be appropriate places for us to consider opening the positions in different stocks. And obviously there's going to be some kind of rotation between the industry groups as to what's going to outperform on a specific reaction, and we want to catch that. And that's how we're going to rotate our selection through this whole rally. Then we are having more of the change of character right here, and I think that this would be extremely difficult change of character for us, to act upon. Obviously, because we're thinking at this point that we are in the reaccumulation, any type of rallies we could trade or swing trade. So even like this type of rallies right here are appropriate to trade, but you have to be extremely selective. And during this period of time, your average holding period is going to be less. Is going to be less than in this area right here. Think about why, guys. Still here, we are in the structure, right? We're still in the trading range. So our rallies are going to be extremely aggressive to the upside. They're going to take less time. They're going to be more volatile. And they also have a very limited potential to the upside. Once we are clearing the trading range, we are going up, and we can hold our swing positions for a much longer period of time. A much shorter swing trade strategy is more appropriate if you want to trade the trading range. One of my suggestions is just neglect this range completely and wait until you're actually experiencing a potential phase C or a backing up action. And that way you will be more in line with much larger moves of the market. So for instance, right here, as we're looking at the structure, I'm putting the down slope right here. First test, second, third test, second point of fear, so potential phase C, sign of strength, backing up action. Please note how it comes exactly to this support level, which is great. And our first positions that would be appropriate for the swing trade is going to be right here on phase C. Our second position entry could be here on the sign of strength. Our third is going to be here. And our fourth entry, and I'm just putting the parallels here, is going to be somewhere here on the breakout. So why am I not using this breakout right here? Because of the sloping structure. We are down sloping, so therefore my breakout is going to be on the down slope rather than on the more horizontal. And all of those places are going to be extremely valuable to us as swing traders to open those positions, to go through the selection. All right, question. What if reaccumulation becomes a distribution? And in this case, it's kind of, where we could potentially go with this, right? Because this first change of character on the flash crash in 2010 is actually quite substantial. It's in line with the declines that we've had in 2007 for a major change of character on before the bear move. So, and let me just refresh your memory here. So I'm talking about this change of character, 12%, and look at what's happening afterwards. Volatility is increasing, increasing, increasing. Then also here in 2000, 14, 15%, and then volatility just increasing, increasing, increasing. Now, what is happening here in this instance? Yes, we do have quite a substantial volatility to the downside, and I think it was just because of that flash crash. If the flash crash would not happen, we probably would have a more normalized, 7, 8, 9% of change of character. But here, important thing is, again, it's about the volatility and how it behaves. From 13%, we're going to 12, to 11, to 8, and then we kind of go into a much more normalized reactions that we have on the way up. So therefore, in the reaccumulation, we are expecting that volatility is going to decrease, and that with that, our first point of entry is going to be on the potential phase C rather than after the sign of strength in the backing up action. The exception to that is going to be if volatility in this range still continues to increase, and therefore that's going to become a distribution, and therefore our swing trades are all going to be to the downside. So that's how we would deal with that. In this case, only because of the flash crash, in my opinion, we have such a high volatility, but the rules of engagement are still the same. Low volatility, increase on the rally, the biggest rally, in terms of any of the percentages, whether of the rally or of the reaction, and then quite normalized, reactions here. 2011. Look at the healthy change of character with 8% here. Does not suggest a big bear market. It's only when we have this shakeout in 2011 that goes to 20%. There is a talk of structural damage, and that we are going to experience a bear market. And I remember that time. Talking to a lot of analysts, hearing their thoughts, and they were just like, this is too much of the decline. We are just basically in the bear market right now. But what's not happening with this bear market is, increase of the volatility. If this is the largest volatility that we've experienced to the downside, where is the continuation of that volatility? The next move shows us a decrease of volatility. Next change of character is decrease of volatility, and next reaction is decrease of volatility. So throughout this whole structure, and considering also that the rally has started to outperform any of the volatility numbers to the downside, any of the rallies that we've had to the upside are being outperformed on this rally in a possible structural sign of strength in the backing up action. This whole area suggests that instead of the bear market, we're going to have a continuation to the upside, so the rules are the same. And again, with this understanding, our first point of entry, because this is going to be considered a reaccumulation, is going to be at phase C. And again, we're just identifying these points of entry based on the market synchronicity, and then we're going to go into the selection. And then the second point of entry is going to be on the way up on the sign of strength bar. Third entry is going to be after the backing up action. And here, because there is more supply, we need some kind of test that comes here. So here's our third point of entry. And then a breakout, which is going to happen right here. So those are the 4 points of entry based on the market. And you can either trade the market, but if you're trading the stocks, swing trading the stocks, these are the points of entries that are going to give you the timing for you to initiate the positions in those stocks that are on your watch list. And I assume that when the stocks are on your watch list, you already went through the leadership characteristics for those stocks, and you're identifying the stocks that potentially are going to outperform the market and the peers. And then for a short-term swing trader, obviously any of these points are great, but also on the way up, on the next rally, any type of healthy reactions that are basically not undermining the volatility numbers on at the more significant spots are going to be great places for us to consider opening those positions. And this is where rotation is going to happen. Like we've seen in the latest rally, we started with the financials. They were the most aggressive. We started with the energy. We started with materials and industrials. And we had a little bit of the uptick in the last couple of 2-3 days in the last week in the tech sector that was heavily underperforming the whole rally. So therefore, you're going to be dealing with the rotation if you're a short-term swing trader in this area right here, and you're going to be dealing with more of the longer-term swing positions in the area where the market is showing, reversal and the confirmation. All right, question. Does it mean that if the first reaction, change of character, has the largest volatility, that next one are potentially, okay, hold on a second. Does it mean that if the first reaction, change of character, has the largest volatility, the next ones are potentially, I don't understand, the next ones, then we are in the potential accumulation. Okay, let me rephrase this question. I think I understand it now. So the question is, if we are in the change of character, and if volatility, and if this is the largest volatility in the whole structure, does it mean that we are in the reaccumulation? So as an idea, yes, but there are definitely some nuances that you can observe even on this chart. So for instance, here we are having a big change of character, and this acts as a change of character to this rally, so we might even think about this as a change of character. Excuse me. And the key here is the decrease of the volatility, as the volatility to the is decrease of the volatility to the downside when the volatility increases to the upside, and we can observe this from here. In this example, excuse me, guys, hold on. In this example here, we are experiencing the largest reaction here. So volatility increases from all of the reactions on the upside, and we still have a larger reaction right here, but it's not necessarily a change of character. That's just a continuation. Again, the idea here is that we want to observe a change in volatility from the largest point, which usually comes on the change of character, as you've correctly observed, but not necessarily that it's going to be the largest in some of the instances. The key is to observe the change of the volatility on the next reactions and change of the volatility to the upside, which is also going to increase. All right, 2013, I'll let you go through this yourselves. It's a little bit maybe, some spots could be a little bit confusing here, so let me just go through one of them. So for instance, all of the healthy reactions, and this is exactly where we would be looking to open our swing positions. This is exactly where we would be observing some kind of rotation in our swing trading. These are the swings that we would be looking for to take. As a long-term swing trader, we would be looking to take this whole thing. So therefore, our change of character here is going to be extremely important for both the short-term and long-term swing traders as a point of synchronicity for the exit. And once we have that change of character, again, we're looking for the contraction of the volatility. So it increases a little bit here, contracts, the rally increases, so we are encouraged here, then slightly increases, and then decreases again. Because we are in the established long-term uptrend, in the intermediate term uptrend, any type of reactions where we could observe the decrease of volatility is going to be great for us to initiate the position. So what do I mean by that? So for instance, if volatility slightly increases, here on the decrease of the volatility, that would be an appropriate place for us to open a position. Even this reaction right here with 5%, slight increase from the previous reaction, but it's still smaller than this too, that define the change of character, that define the range for us that we are looking at. And here in this range, we might be thinking, okay, well, here is our range, and here is our phase A, sign of weakness, upthrust action, for potential phase B, and then potential phase C. So it's, even if it's slightly increasing, and we know that going into phase C, we might have some kind of short-term weakness based on the availability of supply in phase C. So therefore, any type of reversals are going to be great places for us to open its position and not to wait for the confirmation, not to wait for the sign of strength in the backing up action, to enter the position. We've already done that with the major reversal of the long-term trend. We already done this with the intermediate-term reversal. We are what we assume in the reaccumulation pattern, and therefore we are going to be extremely aggressive with our swing trades at the lows, specifically in phase C. And also, it's quite appropriate to trade the swing trades even within the structure of the reaccumulation. And we're only waiting for a true change of character, which we look at here, and it seems like this is something of the concern. This is something that we would be looking for, to have maybe a stop in action further down the road, having a consolidation, and we kind of see that how we are climacting here, and basically after that we are in the consolidation. It's a little bit more hectic here with the consolidation, but the idea is the same. We're having some kind of change of character, and then we're looking at the volatility numbers and they're contracting. So therefore, we're still assuming that we are in the reaccumulation, we're identifying potential phase C, and we are trading this swing to the upside. Change of character, and then again, we're going through the same process until we come to this point. And at this point, again, 13% is a quite considerable number for us. Hold on a second. So how would we be dealing with this? Well, this is more of the scenario in 2011 where we had a range at the top, shakeout, and then we are having a decrease in the volatility. So therefore, this acts more as a reaccumulation to the previous trend. Obviously, there is a distribution pattern right here, and we could observe how from healthy reactions, even here on the way up, we are starting to see how from, let's say, 2% to 2.4, 2.3, 1.5, we're starting to see the reactions that are actually much more than that. So volatility increases, suggesting that we're going to see, some kind of lower prices, even, to these two areas right here, at least. And as we go even further down to check this October 14th low, volatility has increased drastically. It's on par with, again, as I said, with volatility here in 2011, 20%. With volatility here on the flash crash, 13%. With volatility here in 2007, 12%. And volatility here in 2000, 14%. That's usually how bear markets are starting. Now the difference between a reaccumulation with this type of the volatility like we did here in 2011 is that volatility decreases to the downside, and then volatility increases to the upside. So let's just see whether that's going to happen. And we kind of see that on the next reaction, almost a double decrease here. And then we're seeing that the rally is starting to outperform, any of the rallies. And then the backing up action is also quite negligible. So this is where we would be extremely aggressive And then at this point, we would be less aggressive, but we still would be assuming that this is a reaccumulation, so that would be an appropriate place for us to open a swing position. And please note, even if we go up right here, and then we go down in the bear market, what does it matter to us in terms of establishing the swing positions and actually trading this swing? It doesn't matter. We're still going to profit here, and our task is just to get out of this down move once it starts to happen. Because as a swing trader, we are much more flexible than long-term investor. This is the last slide on this. 2015 going into 2016, again, we're seeing a change of character, suggesting a consolidation. Here we see somewhat of the decrease of the volatility, but the result of that decreased volatility is a sign of weakness, failures on the rallies to reach new highs, so suggesting some kind of structural weakness and suggesting some down move, which we do have. Again, it's on par with the 2011, 2014, 2015, in the beginning of 2000 and 2007 changes of character. In all of those instances, we have minus 10 plus increase in the declines. And in some instances, like in 2000 and 2007, as we saw, that volatility continued to be present in the market, which created a bear market. In 2011, 14, and 15, we saw initial change of character with this same type of volatility number, and then we saw how volatility started to decrease, normalize into the sign of strength backing up action, and that basically constituted that we are in the reaccumulation pattern. So therefore, any type of trades, especially after the confirmation, are appropriate to the upside, and any type of healthy reactions are going to be the places where we're going to be swing trading our rotational model between different industry groups. Change of character, and change of character at this 3.5% actually suggested more of the reaccumulation than a distribution. It's not that significant. So a confirmation of that comes on further contraction into these two lows. And as with the flash crash, Brexit just creates an additional volatility that you have to, and this is a nuance right here, that we have to account for as an kind of like an extraordinary event, an event that should be discounted in a sense of production of that volatility and the influence on the future price action. So you could wait a little bit and just to see what kind of price reaction we're going to have to this event. And we have a really good rally, 6.3%, which basically outperforms any of the numbers except for this one. And this rally is definitely much, much better than any of the rallies and any of the volatility that we've had before. Confirmation here on the LPS, and then we are going to become extremely aggressive on the way up. Again, because we're coming in and thinking that this is the reaccumulation. Phase C is an appropriate place for us to open our first position out of the reversal. Sign of strength bar as a second point of entry. Backing up action, or a smaller backing up action, point number 3, and then a breakout, point number 4. And then everything else is going to be for smaller short-term trades for us. The same here with the November 8 election. Look at the move to the downside. 4% still in line with the idea of the reaccumulation. And then look at the volatility, decrease of the volatility. So if we're identifying first, second, third test, second point of fear, potential phase C, here's our first point of entry. Here's our second point of entry. sign of strength in the backing up action right here, or a smaller sign of strength in the backing up action. So you could enter again right here, and then any smaller reactions are still in line with the idea of reaccumulation and the confirmation of the uptrend. So therefore, a question: what is the current market trend? So in this case, we are saying that the long-term trend is up, intermediate trend up, and then at this point, a short-term trend is up as well. But the more interesting question is what opportunities are available to trade in the current market environment, and specifically at this point. And this is kind of like the question that we are asking ourselves consistently during the market outlook sessions, right? What are the opportunities here? So maybe already in your mind you have a very clear idea, because one of the ways how I teach is I repeat one material over and over and over again. So I've repeated this many, many times. At this point of time, what kind of opportunities we're going to have? Most likely we're only going to have short-term upswing, which is going to be either intraday right here, or it's going to be 2 to 3 to 5 to 7 days type of smaller short-term swing trades. And then the next move, more significant move, is going to be probably to the downside. And then the question is, how are we going to trade that? Well, you either stay away from it and you're just concentrating on the next upswing ideas that are going to come on this reaction, during this reaction, or you're going to go to the idea with which we started, with synchronicity, and how we are actually counter-trading the bull market. And you're finding, the stocks that are maybe on some kind of reaction after a very quick move to the upside, are already in the position to go down. One of the stocks that we've discussed, on the previous market outlook session, and Bruce brought that stock, was Vodafone, right? The chart looks so bearish, and actually, it seems like there's going to be a continuation if we're going to have some kind of reaction in the market. So that type of strategy you can develop. Again, I would advise only for more advanced students, to practice this type of counter trend swing trading. And for those of us who are more of the beginners intermediate type of traders, just stick with the main trend, which is what? Which is up, up, and up again. So after the reaction, you also can ask the question, if you're doing this type of analysis on the volatility in the way how I've done it here, what kind of reaction are we going to expect here? Well, a normalized reaction is going to be in line with maybe like between 1 and 2%. A more substantial reaction for the idea of the reaccumulation is going to be in line with these numbers: 3.5, 4, 4.5, maybe even 5%, which led here to the distribution. But I still would be thinking that with this type of volatility to the upside, we might have some, profit taken at this point, and this first reaction might be a little bit more substantial than, let's say, this two. So I would be thinking about like between 3 and maybe 6% for any type of reaction that we might have here that could create another potential reaccumulation range. And obviously, any type of healthy reactions, if we're going to have a healthy reaction right here with an idea of the continuation, that will just continue its move to the upside. And what we are looking for here is a reversal pattern, or as somebody suggested, going into the trading range on the intraday and establishing the reversal pattern right there, and then continuing with the upside. The way how the market developed in the last couple of days, we saw a change of character bar. We saw an attempt to go up. If that's going to fail, that's probably going to lead us to the change of character. But again, I'm thinking that with the current market, we're probably going to have more of the reaccumulation type of change of character rather than a distribution. All right, some questions, and we're going to close up this section. it seems that the stop loss for point number 1 entry is hit on the election day. And we are talking about this day right here. So this is futures, and I apologize, I probably should have brought just a cash market and to put it on the slides. It's just more convenient for me because I trade this instrument very actively. So this is the reflection of the overnight action here. So when we came on Wednesday after the election, the market was already right here, and that was the open. So you would not see this on the cash chart, and basically you would just going in, it's still within the sign of strength bar area right here, so that would be our second point of entry. Our first point of entry was on this bar right here after the reversal of the potential phase C, which I think that is going to be extremely difficult to enter just on the anticipation of the election. So I personally, all of my trades were like done, and I was just just waiting for the election day to happen. Okay, great. Now that we went through this process of identifying the timing of synchronicity with the market, and now that we understand when during the market different market structural points we are most effective as swing traders, and how we could make a definition, give a definition to the market trends in different time frames, whether they are long-term, intermediate, or short-term. Now we can start thinking that during these opportunities, so let's say that we are a short-term swing trader, then any of opportunities with the healthy reactions like this are going to be opportunity for us to go through the selection process and identify the sectors, industry groups, and specific stocks that we would be selecting to trade in the direction of the trend, of the market trend. And obviously for the long-term swing trader, all of those spots that we've discussed are appropriate. So 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. So all of those are also going to be appropriate for us to go through the selection. My only nuance here for those of us who are trading this type of swings is to think that your selection process is going to take some time, right? You're still going to go through quite a lot of stocks. So one of the ways to prepare for it is to do this process as the market goes down. And as the market goes down, you have multiple days here to think about your selection process and go through quite a lot of those stocks, industry groups, which you want to select for your next move to the upside, because you're assuming that we're still in the reaccumulation. All right, so let's talk about the selection process, right? And this is something that I thought that I wanted to simplify as much as possible, and yet to show you different ways of how we would look at those, to show you different tools. And obviously a lot of the tools that we've already discussed. So my challenge to those of you who are students of the advanced Wyckoff course is, first of all, repeat the material. Secondly, find something that you haven't concentrate your attention on. Use this opportunity effectively. Don't withdraw from this conversation. And one of the ways that I wanted to show you this selection is through the tools that stockcharts.com provide us with. And obviously those tools are going to be available on other platforms, as trading platforms, software platforms as well. So it's not something that is going to be extremely unique to stock charts, but there's going to be some of the tools that are going to be extremely unique, to stock charts. And I'm actually not going to talk about all of them, but kind of like the main ones, the ones that I would prefer to use. And one of the first ways to go about this, and we've discussed this before, but this is a more systematic way how I'm going to show this to you, is to use the top-down approach. So what does it mean? Top-down approach. As we give the definition to the market trend, and let's say that long-term trend is up, intermediate trend is down, and then the short-term trend is down. And we are suspecting that we are in some kind of reaccumulation pattern because the move to the downside was not quite significant, or if it was significant, let's say 10 to 15% to 13%, we are seeing that on the next move there is some kind of volatility contraction, so we might be assuming that we are in the reaccumulation, and therefore we would be going through our selection process. The top-down approach would identify first the sectors that are outperforming the market for the specific period of time. So again, on your if you're a member, and I believe this could be also for free subscription as well. And see, because I'm a member, I'm not sure whether that exists for free or not. But on the members page, you can go to the sector summary, and I believe let me just look really quickly. Do we have it here? Yeah, there are other ways, and I'm just going to show you right now as well. You can go to the sector performance charts. So here we are, and you can define the period, which you want to cover in terms of the selection of the sectors first, right? So top down, market, sectors, industry groups, stocks. So let's say that we are interested in any of the sectors that were outperforming. Hold on a second. Let me just close this. Oh, okay, I can't. All right. So any of the sectors that were outperforming in January and February lows of 2016. So most recent example. So one of the things that you can do with stock charts here, if you are just a regular non-paid member, is to go to this performance sector performance chart, and then this is a very great feature here, because as I'm contracting the number of days here, what it does, it defines the time frame for me from 21st of November 2016 to 16th of December. So I can find exactly the days that I need. So I know that let's say from January 1st, let's say in 2016, okay, so let's say January 11th, and then up to February 5th, and I believe we in February we had the February 10th low. Yeah, so here is the in 22 days for this historical period, and again with the current market, you're just going to have it right here, and it's going to show you the same the same type of picture in terms of all of the sectors and which sector is outperforming. So we're seeing how utilities are outperforming, how the materials are starting to outperform, how the industrials are starting to perform, how energy is starting to outperform, and consumer staples, which actually then started to underperform, and the utilities were not necessarily the greatest sector right there. But you're going to go through all of them, and you're going to start identifying on the sector level what kind of groups you're going to choose for your potential swing trading. So we started with the sector then we went to the industry group, and here looking at the example for the previous, that was on August 15th. So for the previous 3 months, I'm looking for some kind of outperformance. And during that period of time, 3 months before August 15th, technology sector was outperforming quite significantly. So we want to go into the details of that particular sector and start looking at the what in, let's say, specific period of time outperforming in that sector. And here are all of the groups that stock charts has for the technology sector, and we naturally would be inclined to go into this area right here. Now imagine that we are doing this analysis, and obviously August 15th maybe was not the greatest place to conduct this analysis, but imagine that we are doing this analysis during some kind of reaction. And the reactions could be different, right? We saw that some of the reactions are going to be appropriate for more long-term swing trader, and some of the reactions are going to be more appropriate for shorter-term swing trader. So the dates here, the period is going to define that reaction. So you're going to take, and this is what I usually do. So you're gonna look at the market and you're gonna say, okay, I'm looking at, let's say, let's take a more recent example and let's just go through this process. So let's say that we're looking at this reaction right here. Let me just bring up another software here, because we are gonna look. Yeah, well, I think that we could definitely start with. No, let's just go to our website. I think it's gonna be easier. One of the tools that you could successfully use identifying sectors, industry groups in this top-bottom approach is a heat map. And actually, Wyckoff Analytics, provide you with this tool. It's being updated on a weekly basis. And one of the neat things about this particular tool is that we could look at the historical representation of the relative strength for the whole market. And that was the purpose for us to create the tool for our students, to practice that technique. So, for instance, again, let's come back to stock charts. Let's pull out S&P and let's just identify the dates here. So here's this reaction. We are starting the reaction on November 25th, and then it lasts until, we might say, this day, which is the reversal date, December 5th. And what we basically want to do is, during this reaction, which to us is a very healthy reaction, it's only 1.7%, 1.8% right here, which is in line with previous reaction, which is less than the reactions that we've had in the trading range. So that suggests a continuation. And if we are a short-term swing trader, then this would be an appropriate time for us to consider entering or re-entering these positions and considering a swing trade to the upside. And we could be extremely aggressive here because all of the trends are in line. All of the trends are up. So let's look at that on the heat map. And here on the heat map, I'm going to enter and in the date range, and that's why it's so great, I think. 25th of November 2016, and then December 5th of 2016. So I'm basically extracting the data for outperformance of the in a specific period of time, and this specific period of time is very small. It's only 2 weeks or even less. But I want to see any type of changes, and with the sector changes, it's going to be probably a little bit more difficult because sectors are not going to change that much. But even with this limited data, we kind of seen what is where rotation is happening. So obviously the green is the color that we would prefer for the leadership, and we're seeing how the materials started to outperform since the election, industrials, energy as well. We're seeing again the rotation that is happening primarily in energy and the financials. So those are the two sectors that are going to be extremely of interest to us. Anything else seems to be not that interesting. So I would be looking at first the sectors that have some kind of rotation from unfavorable or less favorable to more favorable, and then I would be looking at the leadership. So these are the two ways how we would be looking at the heat map. So let's look at financials. So financials were more exciting. And as we go into now more of the industry group level, I'm looking basically for the same thing. I want to identify first the leadership of the industry groups. So look through the top leadership board and then identify some kind of rotation. So I'm seeing capital markets, insurances, we're having this type of the rotation that we're looking for. And that would be in line, for us to think about. This is the rotation here, multi-sector holding from 38 to 19. What else? Mortgage finance, obviously we understand why the interest rates are going up. Financial services as well. So any type of rotation is going to be interesting to us, and plus, just the outperformance. So let's look at one of them. Let's start with the leadership, okay, regional banks. And again, here, the idea is going to be the same, and that is I want to look at the leadership, and I want to look at, through all of the stocks, and I want to look at a rotation. So we took the leadership, but now let's look at the rotation. I see that from 11 it went to 5, and I want to look at the chart right away. Okay, and here we go, and this is weekly, so let's go to the daily. And we're seeing that on December 5th, this is the last, right here, on December 5th, so we are right here. And during this whole period, so we are conducting this research from November 25th, because you have to realize that starting from November 25th, which is right here, to about December 5th, I'm sorry, 25th to 5th, November 25th to December 5th. And I think I have to create the slides, in this logical sequence, then it would be more visible here, but that's okay, guys, I'm kind of showing you a little bit of a new material here. So what's happening here, you have to realize that your selection process, and this is a big nuance, and this is something that I want to put you in your notes. You are not necessarily going to look on December 5th for the best candidates, because the reaction is already been unfolding. You will have to understand that your selection based on the, let's say, heat map tool or any type of relative comparative tools are going to start with the reaction when it starts. So you're going to start looking at this point for the candidates for you to trade. And then as you identify a lot of prior leadership, still the sector, the industry group, and this specific stock outperforming, it's going to go on your watch list right on November 25th. And in your watch list, you're going to say that my point of entry here is going to be just a breakout trade. And my goal is going to be to swing trade the momentum, the continuation of the momentum that we've had since the election right here. Because a lot of institutional interest, a lot of momentum, and this particular swing trade is just going to be a continuation. And my goal is going to be pick up this type of swing out of the consolidation area. I'm recognizing that the consolidation, basically an upslope in consolidation, which suggests a lot of the strength behind it because of this institutional participation. So therefore, I could expect the same type of swing. The character of this swing is going to be slightly different. It's probably going to be less, especially if we're going to have lesser of the demand on the second rally. So therefore, on my watch list, I'm going to say that my point of entry is going to be maybe at 22.75, and I might even have an open order with my broker, for this particular stock. And even though the market is still in the reaction here, I'm going to initiate this position just based on the leadership that this particular stock, industry group, and the sector has during this specific time. So let's see if we kind of got it, from all of these conversations, all of this talk that I've done. Let's see what kind of questions and comments we have, because I just basically went through the whole process of how we're looking at the market, we're looking at the selection. I'm not necessarily devoted a lot of time to the structure or the supply and demand. I touched upon this on this particular stock. But let's see if we have any comments, questions, because this is basically it. The rest of the material that we're going to go through is going to be more specific to, selection ideas and then, specific nuances. Does that make sense, guys? Right? Do you kind of see where we're going with this? How we are going through the selection based first on the market definitions, looking for those opportunities where or when, where in the structure and when in terms of the timing we're going to go through the selection itself. Selection itself is going to be done in a different way, and we're going to go through different ways, of how we would do this. And then we definitely will still need to do a structural analysis, supply and demand analysis, peer industry group analysis, and so on and so forth. But that's basically, in a nutshell, the whole process. Okay, so some questions. How does the method differ if trading futures, let's say E-minis? So we would come back just to the original picture right here with all of our definitions here, right? And we would be assuming kind of like the same idea as we're trading E-minis. And I think I'm going to discuss this more during March workshop on the intraday. And I'm going to show you a lot of the examples of either my personal trades with the minis, because I'm extremely active in the E-mini with the mini instruments. But the main idea, and I'm going to just give you an idea here, I'm not going to go into the details, is going to be still about the definition of the trend, and then a confirmation and switch from a trade in one time frame to another time frame. So in a way, a good advanced E-mini trader is going to be flexible using different time frames for different trades. So what do I mean by that? So for instance, here we are seeing some kind of change of character, and we are having two scenarios: either decrease of volatility and therefore a reaccumulation, or increase of the volatility and therefore a potential distribution. So based on these two scenarios, we would be playing this range differently, right? So as the price goes down here and volatility decreases, we are assuming that we might be potential in the reaccumulation. So on the intraday level here, our points of entry are going to be identified, and at the minimum, our target is going to be around this area right here. Now around this area, either we're going to have an upthrust, so and therefore we might even close the position here, and we just might produce this type of swing trade, or we're going to be looking for the confirmation of the backing up action. If or when the backup action is confirmed, we either are going to keep this position for the further gains, and therefore our time frame is going to switch from intraday point of entry to short-term swing trade to long-term swing trade. And this is that, I call this a universal trader. The universal trader does not really have a specific definition of the time frames where he or she trades, which he or she trades. A universal trader understands the opportunity as it comes in different time frames, and with different instruments as well. So, and that's another layer, but I just want to stay on the time frame here. So as you recognize that this was a reaccumulation rather than a distribution on the backing up action and on the confirmation as the price leaves this trading range, the mentality of the universal trader is going to switch from the short-term swing to the long-term swing trade. And he or she is going to utilize this whole opportunity of the move to the upside. And then, again, observing the change of character, the strategy is going to change here. And the strategy is going to be more trading the swings within the range, and then identifying potentially a more longer-term opportunity. So here, that's going to be a shorter term time frame. And here, once you identify that opportunity again and you confirm it, you're from the short-term time frame, you're going to switch to a long-term time frame. And that's basically an ideal swing trading that you have to perform. And this is what I'm personally striving for. And that's why I'm calling this universal trader, again, because the key to me, at least personally, is to go for the opportunities. It's not necessarily to go for a specific market, up or down. Direction is extremely easy to identify. I think opportunities are much more difficult, because you could think of the opportunity not just as the directional opportunity, but also as a time frame opportunity, instrument opportunity, leverage opportunity. So all of those layers of opportunity have to be discussed, have to be considered. And you are more fluid as a trader if you are understanding that in a different environment, you're going to have a different type of strategy. And by different type of strategy, I don't mean that we're going to change our criteria as to how we select, specific stocks. Or let's say in trading E-minis, we are trading something else. No, it's just going to be the same strategy, but in line with the time frames that we should use, and that's it. More on that in March during the intraday workshop. I'm excited about that workshop as well. I have a lot of material, a lot of new material that I want to give to you guys in March. So obviously, we're in the middle of this workshop, but that's going to be a more appropriate time and place to discuss that. But really good question. Looking at stock charts, what is this? PNTY, point of entry, is selection harder? Okay, maybe this question could be rephrased. I don't quite understand the question. Looking at stock charts, PNTY, is selection harder? Yeah, maybe rephrase the question. Let's go to the next one. Did you go back and date for an example? On selection for today, what would you see? Okay, yes, I did go back just to show you guys because we are not at the correct placement right now to initiate any swing trades unless they are very, very short-term swing trades, right? So just because of the function of where we are with the market, right? So let's just go and quickly look. This is the current market. So what is the opportunity here? Well, we definitely seen this type of reaction that we've seen before. So this is in line with our thinking that we should be in the process of selection. So that is appropriate. But then one of the things here that we have to consider is that this bar right here acts as a change of character bar. And therefore that suggests that maybe the reaction that we're going to have here is not just going to be of the same magnitude, but actually it might extend a little bit more. So what are we doing during this time? We are doing our selection process and we are creating our watch list for the next potential move to the upside. That's what we are doing. At the same time, we want to see what kind of change of character we might potentially have here, how deep it's going to be. Is it going to be of this kind, or is it going to be just, just this, of this kind, and we might have a continuation. So again, we're going to go and do the same type of process that I've just identified. We could do this through the stock charts. Sector summary, then going through the sectors, and we're kind of seeing that utilities are starting to outperform. Why would they outperform at this point of time? And obviously we just looked at the intraday. So let's look maybe for the last week or so. Again, utilities are outperforming. When utilities would start to outperform? When there is some kind of flight to quality and fly away from anything that was just drastically outperforming. So therefore, also health sector, but let's go to the utilities. Then we would be looking at, whatever is outperforming right here. So telecommunications, electricity. We would go and identify the stocks here that would be outperforming for the last week, and then just looking at them, from the structural point of view. So definitely not this one. We want to look on the maybe a large mid cap. So let's go here. Telecom Italia. Okay. And we are seeing how this stock is definitely outperforming right now. So there might be some kind of short-term swing trade right here, but then again, we would have to look at the whole structure. And I'm not necessarily would be excited about the stock from abroad because of the gaps that we're going to have during the European session. So maybe something else. Let's look at this one. And that's basically the process, that we would go through. So I'm not going to go through all of the stocks, but you kind of get an idea of what we would be looking for. Now, again, one of the things that we need to understand is that the trade is not happening right now. We're just going through the selection process. We're just looking through the industry groups and the stocks that could potentially outperform. So we yet to see how this picture is going to end. Would it end with maybe a more of the reaction and underperformance, or would the stock still outperform? And so on and so forth. Okay, so let's come back to our slides here. So as we go through the process, we come to the level of the stock, and then we are going through the structural analysis, supply and demand analysis, peer analysis as well. One of the easiest way to visualize outperformance, and I guys gave you this, especially during the market outlook, we usually look at this picture, is through the relative strength line. So relative strength could be in line with the whole market. So we are looking at the stock outperformance, underperformance relative to the whole market. We're looking at the industry group that the stock belongs and compare that to the overall stock market, and we are seeing that the industry group is outperforming. There is a general trend up, and then that the stock is underperforming relative to the whole market. I'm sorry, this is a sector. And then the industry group in the relationship to this sector. So we saw some outperformance and now underperformance of the industry group of this sector. And then the stock relative to its peers in the group. So an underperformance. So maybe not the best stock, to consider at the point of our entry. And then we would be looking at the structure as well. So there is some outperformance right here in August, but maybe the structure is not completely there. I actually remember we were discussing the stock in August, and one of the ideas was that, is it done? With going, with consolidating. And I felt at the time that maybe not, maybe this was still phase B, and I believe Twitter went up, quite drastically here and then just came back to the trading range. There might be just some kind of absorption in this area that is happening, but in terms of the process, this is what we would be going through. Again, let me just quickly repeat this. Top-down approach. We would look at the sectors, identify the sectors that are outperforming during the reaction that we identified as a meaningful reaction on our time frame, to look for the selection and to establish the position. Then we would go to specific industry groups and identify the outperforming groups on that particular reaction. Then we would go to stocks, and then once we look at the all of the parameters for the stock in terms of the outperformance, underperformance, we would go into the structural analysis and supply and demand analysis. What else could we use? And by the way, for those of you who are interested how to create this picture right here with all of the relative strength lines, here it is in stock charts. You would have to put the price performance, dollar symbol, division sign, semicolon, and then the market proxy that you're comparing it to, or maybe to the industry, or maybe to the sector. And then if you want to put any moving averages, obviously, you can do that. What else could we use for us to identify specific ideas? This is the momentum filtering tool, which you could probably find anywhere, in any of the software platforms. But specifically, I was using this to identify what I call a prior leadership. The prior leadership is going to be anything before that is outperforming the market on the way up, let's say, for the stock that is in a potential reaccumulation area right here. We want to see quite an outstanding outperformance before we go into the consolidation. And the idea here is that the stock is going to continue its uptrend, which was a really significant uptrend right here. And with the contraction of the volatility, which will define the timing, and we'll talk about this a little bit later, we are assuming that the trend is going to continue to the upside. And those are going to be one of the best swing opportunities for the long-term swing traders. So how to identify that type of outperformance? Well, basically what I'm saying here is in the last 12 months, give me all of the stocks that are giving me more than 100% return. And I want to look at all of them. And you can also add maybe within the last 12 months there is a really good outperformance, and yet within maybe like the last 3 months we might have like an underperformance, maybe like on the like plus 10, or minus 20 or minus 10, between those ranges. So what this says is give me this and then show me underperformance during the last like 3 months. You can do that as well. So any type of scans that you can create, reflecting those ideas would be very helpful. And in this case, we're looking at the 12 months outperformance of 11% here, and see how 1 month, 3 months, 6 months actually somewhat underperforming, especially the 1 and 3 months right here. So, and that's exactly what you're looking for. You're not looking for the progression. You're looking for the consolidation to find points of entry. And Skechers was one of those stocks that fell into, on this particular day as I was doing this, scanning, this particular stock came up, and we're going to use this stock for some of the ideas here. A question here, where can I find this momentum filtering tool? Again, this is something that was created proprietarily, but again, I would never show you something that I cannot give to you. So you can use the stock chart scanning capabilities and define these parameters as well. This is probably the most simplistic scan that you can do. Outperformance in the last 12 months by the specific percentage point. So you can definitely recreate this in the stock charts. Okay, what else could we do? How else could we find the same stock? So here is a stock charts example. So what I'm doing here is I'm creating the scan, and this goes into the history. So I'm trying to identify the same day as I was using that same tool. And what I want to do is I want to find all of the stocks that are greater than the weekly close of the 52 weeks times 2. So what that does, again, it gives me the stocks that are going to outperform, during that rally that this particular stock has had. And it shows me that prior outperformance, prior leadership, and I could definitely use this to identify that prior leadership and to look into the structure of the stock and to define whether it's the time for the reaccumulation to leave the trading range and for the price to resume its uptrend. Again, just different tools here that I'm showing. I've shown you the heat map, so I'm not going to really show you a lot of the additional tools here with the heat map. But one of the things that, as we're going through Skechers, again, I'm defining the range that I want to look at. And this is the reaction right here from February 5th of 2014 to, well, actually, this is more than a year. So in the last year, I'm saying, show me the outperformance, and the footwear is definitely has a lot of rotation, recently in this area right here, in this time period. And out of those, I want to look at the leadership, and the first stock that comes as a leadership was Skechers. And obviously Skechers had, a quite significant move after that. Investors Business Daily, and I'm usually looking at IBD 50, and here it's IBD 100, but just take my word for it. And on Saturdays, I usually would like to go through all 50 stocks that they have. And the reason why I want to do this is because those are the stocks that are being followed by so many swing traders based on the IBD methodology. So there is an idea that the stocks are popular among a big number of traders, especially retail traders. And they are going to create that size that's going to create the momentum as well. Also, Investors Business Daily identifying through their selection criteria the stocks that are basically already traveling up, where the confirmation of the trend is not necessary. So it kind of simplifies the process for you. The only problem with this particular selection tool is that you have to understand again where to open the position and when, during which period of the market you're going to open this position. But I already gave you this. During the market reactions in the confirmed uptrend, you're going to go to IBD, scan all of those stocks, and just a lot of them are also going to be in the reaction. But because of the prior leadership, you're going to have an opportunity to go into the stocks, the ones that were outperforming on the previous rallies. So IBD could be also a good use, the good source for finding potential selection candidates. I also like to look at scooters on stock charts, and scooters actually is a fascinating ranking tool, and I put here, a definition for the scooters, how they look at this. And let's quickly look at the formula here. So they have a long-term indicators, which defines all of the stocks that a specific percent of stocks that are above 200 moving average. So basically defining a long-term trend. So long-term trend up. And then a 125-day rate of change, the top 30. So what is this? This is a momentum. So they are basically saying, give me all of the stocks that are long-term up and that have long-term momentum up as well. More short-term here, 125, but still it's a long-term outlook there. And then what's amazing about this tool is that it combines different time frames. Then it goes into the medium-term indicators and then short-term indicators, and basically discusses the same idea, the idea of the trend above 50 moving average, an idea of the momentum, that the price is actually moving, because a lot of the stocks are just going to be not moving during the periods of the consolidation. So we want to come in and establish a prior leadership and then establish a resumption of this leadership out of reaccumulation. And then more on the short-term basis, this is all about points of entry. This is identifying that entry bar, so to say. So, and I encourage you to go to stock charts and go to chart school pages and look at the definition of the scooters. But let's look at the results. And I've just done this actually today, actually last night before the workshop, and I just wanted to give you this example for scooters. And what also it does, it gives you different ways of how you look at the top 10, and usually I would go first to, let's say, this area right here, large caps, and I would look at the top 10, and then I would look at the candle glance. And the candle glance just basically gives me the charts with candle charts, and the glance is going to give me like the top 10. And if I want the whole list, I can go to the whole list. But basically, I want to look at the top 10 during the market reactions to see what kind of stocks are actually long-term outperforming, short-term underperforming, intermediate-term underperforming in some kind of consolidation, and then short-term are starting to move. Think about this idea, right? Long-term outperforming, intermediate-term consolidating, and then short-term is starting a move. Long-term outperforming, intermediate consolidating, starting a move. And kind of like the same everywhere. Right? In this case, we don't have the long-term outperformance, but we're still seeing how intermediate term we are outperforming, consolidating, and then starting the move up. Here, not necessarily the best. Here is outperformance, intermediate, short-term, outperformance, intermediate, short-term entry. And look at this, guys. I mean, how valuable this tool is, for our scanning. If we use this scan when the market has some kind of reactions, right? We've discussed this. We don't want to necessarily be a long-term swing trader and into the position right now. It doesn't make sense. You're not going to make any money because we might have a potential reaction. We already overextended on the upside. But during the market reactions, if you're looking at scooters, this is the picture that you're going to get. And this is exactly what we're looking for. We're looking for a prior leadership. We're looking for a possible reaccumulation consolidation, and we're looking for the point of entry. Isn't that simplified for us in such a Wyckoffan way that it's just like so amazing? And you have to practice a little bit with this. Obviously, like, this is not the greatest candidate right now, even though structurally, it suggests a move to the upside. This one you have to be a little bit more cautious because this is the original accumulation range and not reaccumulation. So you have to account for that, but you still can trade that. But everything else looks somewhat attractive, at least for us to have a look at. And the only thing after that you have to do is you have to go through the structure, you have to go through the supply and demand, and some of the things that are going to be crucial, and we'll talk about them, within the next, 4 to 5 hours. But this is a great tool, so check it out, and definitely I would use this if you're a swing trader during those market reactions. All right, where are we with time? Okay, 12:22. Okay, let's go through this. The more material we cover right now, the better. We are kind of already through the most important points, because now you kind of see, a more systematic approach as to how you're going to do your selections. And now that we're going to go through some of the, after the break, after the lunch break, we're going to go through some of the more common selection criteria for us, like structural analysis, supply and demand. So that's going to be a more of the repetition, and we're going to concentrate more on the nuances and some of the variations. But let's finish this, the selection. So one of the things here that we also have to understand, especially for the long-term swing trader, and by the long-term swing trade, and again, I'm going to reintroduce the definition here, the time frame is going to be from about 1 month to about maybe 6 to 9 months. We are basically trying to catch significant moves in the market, but we also are trying to catch, by the significant, we not only mean significant in terms of the profitability, but also in terms of the duration as well. We want to make the majority of our money in the shortest period of time. That's the efficiency idea right there. So how would we do this? How would we introduce this concept into our swing trading, long-term swing trading? And one of the ideas here is that the leadership is never a single leadership. It's not a single stock that could produce that leadership. It's usually a leadership that reflects a much bigger thematical idea. So what do I mean by that? When institutions are initiating a position, they are initiating a position not in a specific singular stock. They are initiating a position in a theme, in an idea, and therefore their financial commitment is going to be not to a specific stock necessarily, but a number of stocks in the same industry group. A number of stocks, maybe even outside of the specific industry group, but that those stocks also could be related to the idea of the regional idea and what we call more of the horizontal spread of the commitment by the institution. So example of that could be if an institution believes that Apple is going to outperform for the next 3-4 years, and they're starting to invest in Apple. They're also going to consider investing into the suppliers of Apple. So maybe like suppliers for the iPhone screens, supplies for the iPhone batteries, or whatever the suppliers are for the iPhone. Like, Navadir, was the or Intel or AMD was the processes, internal processes for the iPhones, iPads, and so on and so forth. So those companies are also going to be benefiting from the sales of Apple, and therefore investing into those stocks also going to bring, a more diversification, but it's going to be the same idea for the institutions to invest in those particular groups. So therefore, a more appropriate long-term swing trading is going to be based on the idea that you are trading the chunks of business cycle swings, and you're trading the industry groups that are going to outperform within the time frame of a business swing, business cycle swing. And therefore, you're going to be coming in and out of those bigger swings, and you're going to be catching the smaller swings. But during this period, institutions are going to have a rotation even within the industry group. And therefore, what seems to be a leader at one time in the industry group is going to become a laggard, and then the laggard stock is going to become a leader. And it might not be an efficient strategy for long-term trader to jump boats like this and go from one stock to another. A long-term buy and hold strategy is just going to be identifying the leadership earlier on and just staying with that for the duration of the business cycle, and yet adding maybe some additional positions in other stocks when they start to outperform. For a swing trading, our goal is going to be somewhat different. Our goal number one is going to be to define the leading industry groups. Then the second goal is going to be to define the leading stocks in those groups. And then the third goal is to define the rotation within this leading industry group, from leaders to laggards and from laggards to leaders again. So we're also going to be operating on different assumptions, and the assumptions are here on this slide. We're going to assume that the long-term established trend in the leadership group is going to resume its leadership after some kind of consolidation. And in anticipation of that resumption of the trend, we're going to also anticipate a resumption of the momentum. And the momentum is the key for our swing trading. We are looking to momentum to enter the position before momentum occurs, or at least in the early stages of that momentum occurrence. So therefore, this is going to be our goal. So where or when would we be considering swing trading a stock in the leading industry group? So obviously, we want to make sure that the group is outperforming other groups or the market in general. We also want to understand which stock is the leader in that group, identifying that leader, because all other stocks are going to perform in line with that leadership. It's going to mimic that leadership, and it's going to follow that leadership. For the stock that has been lagging, and in this case I'm looking at JetBlue, and it has been lagging as some of the airline stocks already been traveling up since 2009 and especially since 2012. Here in 2012, we are still in the consolidation. We might be in a potential phase C, and then we are confirming the trend, and it's in line with the leadership trend for the whole industry group. So what we want to see before we start swing trading this stock, we want to make sure that the trend in the stock is established. We want to understand that the leadership is also defined, and here the leadership we are defining through the group itself, not necessarily through the stock. And then we are kind of seeing that even in the stock itself, relative to the market, S&P, we are starting to see higher lows and higher highs in this area. High, 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 higher low, higher low, higher low, higher low. So we are establishing a trend. The stride of this trend is not that steep for us yet, but we're seeing that the stock is starting to outperform. And what we are doing is we are anticipating that the trend, the leadership trend in the industry group that JetBlue belongs to, and in the trend of the stock itself is going to resume. And as it resumes, we're going to experience some kind of momentum move to the next possible consolidation within the structure of the longer term trend. And therefore, this becomes as a very, very opportune place and time for us to consider opening a position in the stock that is in the leading group but not necessarily outperforming at this particular time. So this is kind of like a definitional suggestions here, ideas as to why we would be looking at the stocks in the leading group and how we would be looking at those stocks, where specifically we would be looking for position entry for us. Okay, guys, I had my alarm going starting, so it was 12:30. We're gonna stop here, and we're gonna come back at 1:15. And I feel like my tongue needs some rest, so it's definitely a good time for me to stop, have a lunch or have a dinner wherever you are in the world, and then 1:15 Pacific time, and I'm gonna log in maybe like at 1:10, 1:05, and just to allow you an opportunity to log in as well. We're gonna come back and we're gonna continue with our discussion here. All right, guys, I'll talk to you then. Thank you.